Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. I'm Damon Elder, publisher of the DIWire.com, and today I'm joined by Louis Rogers, founder and co-CEO of Capital Square. Louis, Capital Square for many years has been one of the leaders in the alt space when it comes to 1031 exchanges, DSTs, opportunity zones in recent years, with a large focus on the multifamily asset class. Today I want to talk a little bit about something that is somewhat related, and that's build for rent, which is becoming more popular in recent years. So let's start with the basics. What exactly is build for rent? How is it different from typical multifamily? Should it be, considered part of the multifamily asset class?
Great. Thank you, Damon. Thank you, ADISA. That's a great question. What is build for rent? What is BFR? And BFR is basically a segment of multifamily housing. We're all familiar with the other segments: Class A multifamily, Class B multifamily, manufactured housing, and now we have a new class called build for rent. And build for rent is essentially communities of contiguous single-family homes, and they're built for the sole purpose of renting. The build for rent industry is about where multifamily real estate was, say, 20 years ago. Many people don't recall that multifamily was not institutional, but starting about 20, 25 years ago, Sam Zell, NAREIT, the REITs came in, and all of a sudden, multifamily became institutional, and now build for rent has become an institutional asset class. It has a long runway. It's just getting started, but it's not scattered site single-family homes. It's communities of single-family homes, and it can be any number of things. Typically, it's detached homes, or it could be townhomes, or it could be cottages.
So after the global financial crisis that started in 2008, as we're all very familiar with, we did see some institutions come along and start buying up distressed single-family homes, portfolio them together, some of them even listed. This is not that, right?
This is not that. This is a community of homes, not scattered site homes all over creation.
So these are like master plan developments?
They are.
Like that?
Many of them are gated communities. They look like a residential community of homes. They're just rented homes.
So how does the tenant profile differ from traditional apartment tenants? What are these renters looking for? What are the demographics, the economic profile?
It's very similar to the trends in multifamily. We started noticing about 5 years ago that the 3-bedroom apartments stayed full. They were very stable. And we started wondering, gee, how come nobody leaves a 3-bedroom apartment? And that's because there was a demand. And the demographic of the 35 to 49-year-olds, which is the fastest growing population, families, they have kids, they have a dog, they've outgrown an apartment. And so the build for rent is a solution for them. They want space, they want privacy, we all want a yard, we want amenities, and we demand excellent schools. And the build for rent asset satisfies all of those needs. But that's the demand side. Demand is very strong. Supply side is very constrained, and they can't afford to buy a home. And you say, well, why can't they afford to buy a home? Well, there's a housing shortage. There aren't that many homes available. We call it the locked-in effect, where if you have a 2 or 3% mortgage, guess what? You think you're ever leaving that home?
Right, you're not going to sell in this environment.
30-year, 2% mortgage, you're not going anywhere, so that cuts down on the supply. We're roughly 4 million housing units short, and it started in 2008 with the great financial crisis when housing stopped, and then again in 2020 with the pandemic. Guess what? Housing stopped. And here we are in 2023, again with interest rates and the economy. Housing is going to stop. And so, why can't people afford to buy a home? Well, there aren't that many to buy. The purchase price is high. And many of the residents, potential homeowners, have spent their COVID savings. They bought a Peloton and did all the things they wanted to do, and they don't have the down payment. What this segment of resident population is looking for is flexibility in 2 ways. They're looking for leasing flexibility. It's a 1-year lease, just like an apartment. So if they have a job change, they can leave. If they want to move to another part of the country, they can leave, but they tend to stay longer than regular apartment residents. So they have the freedom to move, and they also have financial freedom because they don't have to worry about the air conditioner, the roof leaking, the
They get all the benefits of home ownership without the headaches, right?
no maintenance, no repairs, and a fixed rent. So it satisfies the demand for people that need a home, but can't afford one.
So turning to the other side of the equation then, from a landlord,
Yes,
an investor perspective,
yes.
what's the attraction to BFR communities?
It's a great question. It's a little different for each of those groups, landlords, residents, and investors. But from the landlord standpoint, residents stay longer. If you have kids in school and lots of furniture, you don't move so fast. Lower turnover means, guess what? Lower maintenance cost. Lower maintenance cost means, guess what? Higher yield and higher leverage. And so from the landlord standpoint, the residents are stickier. And then from the resident standpoint, they have a home at a reasonable cost. It's in a great school district. It satisfies their demands, leasing flexibility, financial flexibility. And it's important to note the cost to own is roughly $1,500 a month more expensive than to lease. So there's a big financial incentive or disincentive to own right now. From the investor standpoint, it's the same story as multifamily. We've been talking about the migration from the gateway cities. It was accelerated during the pandemic when people started moving out of your big cities into the suburbs. They were following less dense areas to live, and jobs followed. Strong job growth throughout the Sun Belt. That led to stable occupancy and rent growth. From an investor standpoint, that has been a very positive development. Apartments and build-for-rent communities are full. The rent is strong. They're stable. And it's interesting to note that only 4% of housing is institutionally owned. That means mom and pop is maintaining the property, and you get what you get, compared to an institutional owner with a first-class property manager would create a much higher level of amenities, much higher lifestyle, much higher quality. And then a subtle point from the investor standpoint is build-for-rent communities can be built in tranches. So you can build phase 1 and lease it. You can build phase 2 and lease it. You can build phase 3 and lease it. You're generating cash flow along the way compared to building a multifamily community where you lease at the end.
So Louis, the time-honored adage in real estate is that location means everything, right?
And
how
does.
So, and how does that relate to BFR? Is geography important? Where are the best places to be developing these right now?
It's critically important. We like to look at the U-Haul one-way statistic from, say, California, from your town in California.
A lot of people ship it out.
To anywhere in Texas, the U-Hauls are going one way. They're not coming back. Geography is critically important. We're talking the same as multifamily. It's the same story. We're talking about high-growth Sun Belt markets, typically the suburbs. Build-for-rent requires a large parcel, so we're typically 30 miles from the city. In the suburbs, Atlanta suburbs are very popular. Raleigh, Dallas, Fort Worth, we've all heard about the growth in Texas. How many headquarters have moved to DFW? And Phoenix, a very large city with a big population and growth, job growth, low cost of living, high quality of life. These Sun Belt communities are full of governments that are friendly.
Speaking in terms of working with municipalities and residents, oftentimes when a developer comes in to build something, there's neighborhood groups that are opposing new development of any type. Some cities are friendlier than others. Generally speaking, are the cities, the municipalities, the residents of those areas, are they friendlier to this sort of BFR development than they are other types?
The suburban local governments tend to be friendlier. They've seen the job growth. They need housing. We're 4 million housing units short. And if they don't produce housing, they're not going to bring in the employers. Employer says, where are my people going to live? And so there's a balance.
So, Louis, as you alluded to earlier, the U.S. has been in a housing crisis for really decades now. Massive million plus, 4 million shortage of housing?
4 million housing units short. and roughly half of the rental housing stock is old, obsolete, and decrepit from 1980 or earlier.
So that, I think, begs the question, isn't denser developments like apartment towers and in large suburban areas or large urban areas, wouldn't that be a wiser choice, generally speaking, from an investor's perspective, than these more diffused BFR kind of communities?
There's a place for both. They just operate differently. And there's room for both regular multifamily A and B and build for rent of homes.
So then on the flip side, obviously home ownership has become increasingly difficult. Again, you spoke briefly about this in the introduction. So especially for middle and lower income Americans, and now with interest rates getting to the highest point in more than 10 years, it's even more difficult. So, I think I read recently a Fannie Mae study that demonstrated the majority of metro area in the U.S. suffer from chronic lack of affordable, not necessarily subsidized, but
Yes.
affordable single-family housing for both renters and homeowners. Is BFR going to help solve this issue? Can it
Yes.
solve the issue?
The BFR is adding to the housing stock. We're providing supply and taking away some of that shortage. Absolutely.
And I think as we talked about earlier, you mentioned that it's actually more efficient and quicker to build these communities.
It is.
Okay. So
It is. We can build them in tranches and get them online quicker. And because there are fewer build for rent communities, the demand is actually stronger than just regular old multifamily.
So BFR, build for rent, build to rent, whatever you want to refer to it as, we've started to hear about this asset class from an investment perspective in recent years, but not a lot. Capital Square last year made a concerted effort to enter this space. Are there others? What's the bandwidth? What's the marketplace look like? Are we going to see retail investors starting to embrace build for rent?
Retail investors are embracing build for rent. For the last 5 years or so, it's been an institutional asset class. Blackstone and Starwood and Invesco have invested heavily in build for rent. They're very sophisticated. It's now become a retail asset class, and it's the same story we talked about. It's the same story that Dr. Peter Linneman talks about when he says we're in the golden age of multifamily investing. Why is that? Well, we have residents who stay longer in the build for rent space. We have less turnover cost. We have necessity. It's an asset you need. You need to have a roof over your head. And so it's inflation resistant. And even through the pandemic, multifamily, all the segments of multifamily were basically full. And so retail investors seek the same things that the institutions wanted and a hedge against inflation. We have 1-year leases typically, and so every year you can reset and you can raise the rent, and typically multifamily of all segments has more than covered inflation. And then the last but not least from Dr. Linneman, multifamily has had no losses in 40 years unless you over leverage. So it's very safe, necessity-based, and a very strong economic model.
Yeah, we have a very significant cohort of young people in this country who are starting to form families and probably would be very attracted to the single family housing option. But again, they just can't seem to afford it right now.
They can't afford it. Maybe a couple of years ago they could have afforded it, but with the shortage of supply, with the lack of a down payment, with the housing that's available being so expensive, they want to live in a home, but they can't afford it. The BFR is a great option.
So last question for you. I want to stick a little bit more in the weeds on the investment side of things. From a retail investment perspective, as a product sponsor, how does BFR work best? Do you put it into a DST structure, LLCs, REITs? How should they be packaged?
They fit in various places. They fit very well in DSTs. They fit well in development funds. They fit well in REITs. Each one's a little bit different, and it depends on which segment, which strategy we're talking about. With the build for rent, you have ground up development, where you're taking a piece of land, you're building a building ground up. That's the highest risk. It's also the highest return. That doesn't qualify for 1031, but does qualify for a development LLC. High risk, high return. And then there's sort of a middle ground, which is what we call the forward sales, where we buy from the developer on C of O. When the certificate of occupancy is issued phase by phase. We buy, which reduces the risk of development, and that is sort of a middle ground, and that works great as a DST or as a regular plain old cash investment. And then finally buying stabilized, built and rented communities. That's just like any other A or B multifamily, very stable.
Just like building an apartment building,
Just like-
except collection of single-family homes.
It's built, it's there, it's safe. So different strategies for different structures.
So Louis, thanks for sharing your insights today. Like I said, I know I find build for rent to be a very interesting emerging asset class in the retail space. I'm sure our viewers do as well. Appreciate your insights and you sharing your information with us. And thank you so much for joining us for another edition of Focus on Alternatives hosted by ADISA. Again, I'm Damon Elder, publisher of the DIYer.com. For more educational information on alternatives of all sorts, visit adisa.org. And of course, for your daily news on the alternative space, visit thediywire.com. Thanks so much.
Thank you.